Good morning, everyone. My name is Andy Barcade, and I am the publisher of the Think to Retire newsletter. And this is our month in review webinar for June. It's Friday morning, about midway through the morning. And I'm just going to hopefully there's a lot of people already waiting to get in the room. Some of you are already here. So just in the interest of time, I'm probably just going to go ahead and get started. Again, we try to keep these to 15, maybe 20 minutes. We're going to put them on the website this afternoon. And we kind of came to a decision. I just want to bring this up to your attention. We used to try to do these live, and we found out that few people were watching them live just because of, I guess, their lives getting in the way. So we've decided to just record them, stick them on the website, as we always do, but then again, send you an email right after the recording, right after they're posted on the website to tell you that they're available. So you can just jump on the website whenever you have time, maybe this afternoon, maybe over the weekend, and just have a cup of coffee and listen to the webinar. And as always, we want your feedback. We want you to call and ask questions and set up demos just so you get the best out of our newsletter service. So well, let's get started. Okay, this is the ways to communicate with us, as we always put up there. There's our phone number. There's my email that comes directly to me. I look at that inbox every day. Our website, and again, on the website, you'll see many different ways to request a phone call, request a demo. And we can just call that phone number and say you want to get on my calendar, and then my staff will find time that matches yours so we can actually sit and talk for a while. And again, look at the archives of this webinar, look at the archives of our newsletters so you can kind of check back and see how the allocations might have changed. And we're trying to really communicate well with our subscribers. So, okay. This is what the S&P has done over the last month, June, as of June 1st to now. Now, granted, I built this last night, but the market this morning is up, it's doing better. So these numbers are a little lower than they're probably going to end up the day. As we speak, the S&P is up a couple hundred points, so we'll see how it ends the day. But as of last night, the S&P was up about 1.4% for the month. The 10-year Treasury as of yesterday was about 1.48, and it's pretty much the same this morning. Some of the things driving the market, and I looked at this yesterday to update it, and I didn't make very many changes. The same things have been on the market's mind over the last several months. We've had great earnings come out. We had some good earnings come out yesterday, which helped drive the market. We had, I think it was Nike had a blowout quarter, and the stock was up 13–14% yesterday. So these good earnings still persist, and that's what really the market is sinking its teeth into. We've had some good economic numbers come out as well. Earlier this week, we had good jobs numbers. We had another read on the gross domestic product, which was strong as expected. And we had some strong durable goods orders. So the economic data is supporting the earnings that are coming out. And that's why the market has actually been very resilient in the face of what a lot of people would consider pretty negative news. And again, this is some of the negative news, all the spending that's happening, but that is helping drive the market. There's still the potential of the big infrastructure bill. And yesterday, the White House, as well as some of the folks in the Senate, and actually more the House, I think, came upon a bill to agree. Now, it hasn't been law yet, but they've agreed on about a $579 billion stimulus plan for infrastructure. Now, we'll see if that passes, but that helped the market a little bit also yesterday. We've got an American Families Plan that's still kind of working its way through the system. We don't know what that's going to look like yet. But again, Wall Street is expecting these inflows of cash into the economy, and that'll probably filter down to the market and drive earnings. And that's, back to bullet point number one up there. Is that going to cause problems down the road? Probably. But anybody that's been around the market for years realizes that the market is not really looking 2, 3, 4 years down the road. They know it's out there. They know there's some potential problems perhaps, but they're looking at what's right in front of their face, the next quarter, the next 2 quarters. And that right now it likes what it sees, the market. That can change, and it will eventually, but not today. Some of the other things that the market is hanging its hat on is a vaccine. Even though the vaccine percentage of individuals taking it is kind of slown, that's helping the economy. COVID's kind of being pushed behind us for the time being. Economy's reopening. Inflation is still that thing that's kind of hanging back in the wings. It's made people a bit nervous. We had some CPI, Consumer Price Index, and Producer Price Index inflation numbers come out over the last couple of weeks were very high, higher than expected. Actually, the PPI, the Producer Price Index, that 6.5% reading is the highest on record, period. We had some other inflation indicators come out this morning, which were highest, the highest base consumer inflation numbers since the 90s. So, but again, the market's not paying attention to that right now. That usually is bad news for the market because that will indicate that the Fed's going to possibly tighten a bit and push up interest rates. Interest rates hadn't gone up, the Fed hadn't tightened, the market is not paying attention to this yet. Probably will eventually, and we'll keep you posted. And again, we've got the prospects of higher taxes coming down the road. So we'll keep you posted here as we do our webinars. And then again, just pay attention to the news wires, pay attention to what's happening out there. Okay, this is how we were allocated in June. Our 4 industry sectors which showed the highest relative strength were energy, basic materials, financials, and industrials. And you all should know this. It's on our website. What looks like might be changing this month, the probable change for next month, July, real estate, that sector has been rising in strength over the last month and is more than likely going to replace industrials. Now, again, that's probable. Today, it looks like that's going to happen. But again, our newsletter is not going to come out for a few days till the 1st, which is towards the end of next week. So that's something just to kind of keep on the horizon and kind of keep under your hat. All right. We have a new model. I mentioned this last month in our webinar, but I want to bring it up again. It's not ready yet. We're probably a few months off of having this ready for prime time. We're going to have a dividend income model, a DIM, D-I-M. Now, a lot of our clients are getting near retirement and they want income from their portfolios. And this is Think to Retire's answer to that, the dividend income model. It's going to be comprised of probably a dozen to 15 different dividend paying stocks. Some will pay monthly, some will pay quarterly. The stocks will be picked because of their consistency and persistency of paying dividends, and a lot of them increasing dividends. Dividends in good times, dividends in bad times. We want consistency. And right now the yield is about 6.7. That's what the yield is today. We want high income. And again, we want stability of dividend. We want stocks that have paid dividends through thick and thin. Even through COVID, which a lot of companies cut dividends, and dividends aren't guaranteed. A lot of these companies, actually all these companies in our model, pay dividends right through. So we want companies that are going to be consistent because you as a soon-to-be or current retiree want that consistency of income. Now, this model is going to be made available to you as subscribers right along with our AIA, Adaptive Investment Allocation Model. Same price, no additional cost. You're just going to have that model. And as we build out this newsletter, we'll more than likely have more models down the road, more services down the road. For us, it's a one price, you get everything. Most newsletters out there, if anybody has subscribed to one before, there's always some kind of an introductory price, and then you get come-ons, you get upsells forever to try to get you to take their new secret service or their new great report that you don't get with the service you're paying for. We're not going to do that. You pay one price, you get everything we have on this site. So when this model comes out, which we're still probably a couple months out, when it is live, you'll know. I will send you an email telling you to jump on the site and look at it. But until then, to get the assurances from us, everything on this site, it's one price. There's no upsells. So when this is available, we'll make sure it's made aware. You're made aware of it, and you have access to it. Okay, this is the part of the monthly webinar where I somewhat get a little bit repetitive. I talk about what we're doing at Think to Retire, the philosophy, what we're trying to do as it pertains to showing you and helping you use this newsletter as a good financial tool. The more you hear about it, the more you know, the more you can use it the correct way. The Think to Retire newsletter is basically trying to help you make good financial decisions over the long run. I think the big gem or the most important thing of our website is adaptive investment allocation, AIA, which we're going to talk about in a minute. But there's other things you have to be aware of. It's just not about investing your money. That's a big part of it, but you want to make sure you're staying up on things like Social Security, Medicare, estate planning, taxes. So we're going to feed you every month a couple of bits of information, articles we find that are somewhat topical, somewhat up to date, to try to keep you aware of what's happening. So you can look and make sure that these things that are going on out there, how they might affect you. So again, you can just be more aware and you don't get caught looking the other way and have it cost you money. We're also going to have our weekly market in review emails that come out Monday morning. You should be getting those. If you're not, that probably means we might have a bad email for you, so let us know. And then again, you're going to get these webinars on an ongoing basis, along with the monthly newsletter, which is going to come out the first business day, the first trading day of every month. Okay. Just to start talking about AI, again, I'll be redundant, so I'll try to be not too redundant and get to this relatively quick. But AIA is mainly sector rotation. Sectors in the market tend to change as far as their relative strength. That's kind of a funny way of saying the market, based upon the economic circumstances surrounding the market at the time, tends to favor certain industries, certain market sectors, certain asset classes over others. Some produce better returns, some lag. Our goal at AIA is to keep you in front of and keep fed to you the sectors that are actually the strongest, the ones that have the highest relative strength, and keep you away from the ones that are lagging. And again, our goal also is to reduce your volatility, which we're going to talk about that in just a second. Give you a good rate of return, reducing risk without sacrificing that rate of return, and also keep the cost down. All you're going to pay is the annual membership at Think to Retire. You should be on a trading platform somewhere where there's no trading costs. So your management costs, your trading costs over the long run are greatly, greatly reduced, and that money stays in your pocket. And for those of you that are maybe new, if you haven't looked on the website to some of the demo videos, please do that. It'll explain things. And again, the more you hear about them, the more you'll understand it. And also, if you want to have specific questions and something's just not making sense, set up a demo and we'll go through the numbers, go through the methodology of Think to Retire and AIA. Okay. All right. Many of you have seen this. I come back to it every month because, again, the Dean of Wall Street, Ben Graham. Oh gosh, I've lost track of his name. Well, I'm going to go on, but Ben Graham was an old professor and kind of considered the dean of market analysis. Warren Buffett finally came back to him. He was Warren Buffett's mentor. Warren Buffett was his student back at Princeton in the day. He said many things, but one of these things kind of emphasizes the whole idea behind Think to Retire. The essence of investment management is the management of risk, not the management of return. We're trying to reduce volatility. When the market goes up, everything is going to go up with it. So we're trying to make sure that we're not getting hurt along the way. We want to capture most of the market gain and miss or avoid as much loss as humanly possible. Okay. Again, markets have personalities, and we just kind of went through this, so this is a bit redundant. But again, they're changing with the economy, and that's an ever-changing rotation. Stronger sectors are going to rise to the top, weaker ones are going to come to the bottom. We want to keep you in front of the more higher relative strength sectors on an ongoing basis. Your money can be constantly moving in the right areas. I'm going to go through that. Don't need that one. Okay. I believe most investors don't do well or underperform or make mistakes, not because they're not intelligent, not because they're not committed or they care. Most of them don't do well because they don't have some sort of a system, some sort of methodology, something that's got rules that keeps them going in the right direction. It displays to them why they're making decisions on an ongoing basis. Well, AIA can be that system for you. It's based on math. Is based on algorithms. And again, it's not perfect, but it's consistent. So it's giving you a reason to do what you're doing and giving you a reason to change when you need to make changes. Okay. The AIA, the Adaptive Investment Allocation, is basically a two-step process. Step one, we're asking, do we want to be in the market or do we not? We have risk indicators that are risk management indicators, which are doing this for us. We have two of them, a short and a long term. Both of them must be positive for us to be in the market. If either one turn negative, we're going to send you an alert to back away from the market, to move out of AIA into something safer, bonds, cash, fixed accounts, something like that. But the idea is when the indicators are telling us, when the math is indicating or suggesting that a downtrend might continue, we want to move away. And on the flip side of that, when the market starts to bottom and come back up, that those same data points are suggesting that this new upward movement looks like it's sustainable, we'll issue another alert to move back in and give you the sectors to move into. Okay. Step two is if we want to be in the market, which we are truly in the market a lot more than we're not. But the second step is what areas of the market do we want to be in? This is where the sector rotation comes into play. As I mentioned earlier, these sectors are always rotating as to which ones are the strongest, depending on what's happening in the economy. They don't rotate every month, but there is a constant rotation over time. We are watching those, and we're going to feed to you as subscribers the top 4 sectors every month to allocate your money into. The next month, we're going to look at it again, and if there's any change, you're going to know about it so you can update your portfolios. If it goes negative, like I mentioned, if one of the risk indicators turn negative, you'll be sent an alert to move away from those sectors into something safer. Okay, it's important to understand your risk. Most of you have taken this risk assessment. If you have and you haven't done it for a while, it's not a bad idea to take it every year or so, just to kind of make sure that how your money is invested is lining up with your tolerance for volatility. This is one I took on myself. Actually, before I go there, if you go to back to the website on step 1 under the process, which I believe is our first drop down on the website, you'll find the link to the risk indicator, or excuse me, the risk management questionnaire, and you can go take that again. But again, this is one I took on myself, and I came in at a 57, which is average risk. So I'm pretty moderate as far as that goes. Now, the way I might use AIA if I have this risk level, and each of you can use it differently, depending on your risk level and how you believe what the market's going to do. For a moderate investor, I might have only about 60% of my money allocated to AIA, those 4 different sectors. The other 40% of my money should probably be in something safe. I don't want, as a moderate investor, a moderately conservative investor, I wouldn't want all my money in the market anytime, ever. So I might have maybe 60%, maybe it's 50% for you. The rest of it would be in something like bonds, cash, fixed accounts, which are not into the market, they're safer. So your overall portfolio may be less volatile. That's in a positive market. If the risk indicators flip to a negative market, we'll move out of AIA and go back to bonds. In this case, we'd be completely out of the market and something safer, kind of sitting on the sidelines, waiting for things to calm down before we move back in to put the 60% back in the different sectors. Now, another risk level up, or a couple of risk levels up, something more growth oriented, which could be because of your age. Maybe you're younger, maybe you have a lot of experience with the market and you're okay with taking more risk. You might have 80, 90% of your money in AI split between the 4 sectors. And maybe a small sliver, 10%, 20%, maybe none, out of the market into something safer. This is if you're a bit more aggressive. You can handle the volatility and risk. Even though AIA and the risk management indicators are bringing down that volatility, there still will be some day-to-day, week-to-week volatility. Now, when we move out of the market, when the risk indicators tell us that, we'll move back to bonds and sit on the sideline for a while, with the idea of preserving value. Okay, here's some of the returns. And let me move, well, this might not move, but again, these are on the website too. So again, this may help you look at these. Now, everybody looks at the 2 lines. The bottom line is the S&P 500. The top line is the moderate model of AIA, which is mainly 60% in AIA, 40% bonds. And you can see that which line looks better. But I think the most important graph on this page isn't the graph of return, it's a graph of risk, volatility. As you can see, the dark area indicates the volatility over time that the S&P 500 took. The blue area, the blue shaded area, is the volatility that the model took. And this is mainly because of the risk indicators. These big drawdowns, these big hits that the S&P took, the risk indicators got us out of the market, and we missed most of that downside, most of that volatility. And that's one of the major reasons why the models, the AIA moderate model, outperformed the market. It didn't take the big hit. So if you didn't take a 30, 40, 50% hit, you don't have to make all that back up before you actually start making money again. And if you look at it, just look at the returns. The returns on the S&P over that period of time, roughly 2001 to the end of 2020, were about 6.9. And the returns for the model are about 12.6. So it's a big difference in rate of return, but I think more importantly, look at the volatility. Look at the maximum drawdown, which maximum drawdown is defined as from peak to trough, the biggest dip that was taken during that period of time, the biggest drop. And the S&P was over 55%, 55% here during the mortgage crisis back in '07 and '08. For the model, a little less than 10, 9.9. So you had better performance over the long run, and it was a much, much smoother ride. Again, there was volatility. If there was no risk, if AIA could produce a completely risk-free environment, which we aren't, it would be a straight line. But you do see there's some dips and dodges in there, which means there's weeks and maybe periods of time where the market's tailing off a little bit, but we're still in there because the risk indicators are telling us that the data is suggesting we still want to be in the market, but it's not perfect. Okay, now that was moderate. Let's go to something a little more growth oriented. This is the growth model. Everything looks relatively similar, but the rate of return is a lot bigger. Instead of about 12%, it's up a little over 14% over that period of time. And again, the drawdown is a little bit more because we're more in the market. Remember, we're about 90%, 10%, 90 in AIA, 10% in bonds versus 60-40. So we're a bit more in the market. So our drawdown was 12%, 12.2 versus 9.9. But still, our rate of return over the long run was much, much greater. Okay, kind of coming to the end of it. Sorry if that gets a little bit redundant, but I want to make sure that you're constantly hearing why we do what we do. Then we can get more detailed, talk about your personal circumstances. We don't give you individual advice, but again, we can explain how the system works and maybe different ways you might use it, and you can actually take it home and make it your own. There's our phone number again, my email, our website, which you can request demos and phone calls from. And again, look at the archives of the different demos. This one will be probably archived sometime today, and I'll send you out that email telling you that. So hopefully you're seeing it on the website. You've been listening to it. So until then, have a great weekend. Have a great Friday. And I'll be back in about a month with another webinar. My name is Andy Barcade, and I'm the publisher of the Think to Retire newsletter.